This is your mortgage rate watch for Tuesday, March 22nd. I'm Keith Akada with the Mortgage Reel. We continue to talk about the safe haven trade of the United States and what happens when there's crisis and a concern globally in any economy or events that happen around the world. Well, today is no different than any other day with the events in Japan that thankfully it looks like they have their nuclear reactors under control and that situation is starting to stabilize. It is having a negative impact on the bond markets today as that safe haven trade of the United States, those funds that were invested here as a crisis has erupted, is now shifting back out, moving back overseas or into other parts of the globe. Also, the other thing is the lack of news coming from the Middle East. This is a good thing, but again, with the lack of news, that's also having an impact on the safe haven trade, and that's pushing funds out. So as we're looking at the bond chart this morning, we are now on our third consecutive day on a downturn, and what that means is prices are being pressured higher as far as interest rates from the bond prices having to increase their yields to attract some of these investors back into the market. One thing that we're watching very closely here in the United States is the core inflation rate. The producer price index came out much higher and hotter than expected. And what this is really saying is what's going on in the United States as far as core inflation because of the cost of energy is rising the cost of all goods to us and the consumers. Well, looking at this from a corporate world, the corporate battle in the stock market is now having to look at how corporate America is going to look at their pricing. Are they going to pass on the cost of higher production costs onto the consumer by increasing the prices again to us on the retail side, or are they going to keep it because of the recession and we're still totally not out of that in economic recovery? Are they going to keep the prices the same, and then in turn corporate America and the private sector is now going to make less as far as earnings? Well, if they make less in earnings, that also means that Wall Street is not looking at them as optimistically, and they're going to start to shift their investments. And this is also hurting stocks and also hurting Wall Street. And in the big picture, it hurts corporate America as far as returns. So, in the bottom line is the questions being totally debated right now: are the consumers going to get stuck paying this tab? And unfortunately, it's a tab left at the bar that we don't know if we're going to have to pick up, and it's an open tab at the moment. So keep in mind that this all has the bottom line pressures on inflation, and inflation with mortgage rates is super critical because the minute media, Wall Street, economists start pounding the word inflation out, almost instantaneously we see the yields on bonds spike and mortgage rates react right with it, and mortgage rates are pressured higher. It's extremely volatile anytime the word inflation is dropped. So this is something definitely we'll be following in the months to come. Another big announcement that we weren't totally ready for, but at the same point not surprised, that the Treasury Department announced yesterday that they are now going to announce in the sale and unloading $142 billion worth of mortgage-backed securities. Now, these mortgage-backed securities were purchased by the Treasury in 2009 and 2010 in order to stabilize interest rates. When on the flip side, as they begin to sell, that's going to add a lot of pressure to the bond market because especially with the events going on in Japan, the second largest holder of United States debt and purchaser outside of China being in first place, if Japan is in a situation where they can't purchase the U.S. debt and China is uninterested in purchasing more, then it really poses the question, what global markets are interested in purchasing the debt in order to keep their currencies low, because that seems to be what the battle is here in order to keeping domestic trade and everything going. So in the whole ball of wax of things, this could apply a lot of pressure to the bond markets, and what that's going to in turn transition to is possibly driving up interest rates gradually again over the course of this year. This is now two things that we weren't expecting to happen this year. Number one, inflation. Even though the Fed says inflation is under control, we're seeing it driven up because of core inflation, because of energy. And number two, the Treasury coming out and saying they're unloading more supply. And if you're going off supply and demand theory, very simple. If there's not enough demand and supply is put out there, what happens? Either the prices have to go up on the bond side, or for the retail side, prices will go down. But we're looking at the opposite side. Too much supply, not enough demand, and that's going to drive the prices of the bonds higher. And that, unfortunately, is going to trickle and translate to the same thing happening with mortgage interest rates. Make sure to leave any comments, feedback, or questions below. We'll make sure from Team Mortgage Reel to get back and answer those as quickly as possible. We have a special request we'd like to make before you leave, and hopefully you've enjoyed today's clip. Make sure to check on the home page, click on the banner at How to Beat the Banks, and that'll take you directly to our Facebook fan page. We definitely put out more and more information, and to create transparency in the financing process of home ownership. We're big advocates of home ownership, obviously, but we want to make sure it's as easy as possible to understand what's impacting and the education necessary for home ownership today. And when you're visiting us on Facebook, make sure to like us when you're there. Thanks for tuning in to Your Mortgage Rate Watch. We'll be back with more news impacting your largest investment, your home.